Okay, so we are now in the second half of the our second module, which is entitled Financial Environment. So our next topic is about the financial instruments and its classifications. Okay, so when we say financial instruments, these are assets that can be traded, or they can also be seen as packages of capital that may be traded. Most types of financial instruments provide efficient flow and transfer of capital all throughout the world's investors. So again, financial instruments is uh, this is the medium of exchange that can be in the form of assets that are traded, and they can also be seen as capital that may be traded as well. So these are the instruments that is being used in financial institutions for that financial and monetary transaction. It's like a currency, okay, in the financial world. So these assets can be a cash in the form of cash, a contractual right to deliver or receive cash, or another type of financial instrument or evidence of one's ownership of an entity. So these are the functions of financial instruments. So a financial instrument also can be real or virtual document representing a legal agreement involving any kind of monetary value. So financial instruments can also be divided into two types. So they can be cash instruments and derivative instruments. Financial instruments also may be classified according to their asset class, which depends whether they are debt based or equity based. So, foreign exchange instruments, this comprise a third and unique type also of a financial instrument. So, we go now to the different types of financial instruments. Okay, so we've mentioned earlier cash instruments. So these cash instruments, their values are directly influenced and determined by the markets. So this can be securities that are easily transferable since they are considered to be the currency, okay, that we are using. So that's why they are acceptable, or they can be acceptable. So cash instruments may also be in the form of deposits and loans that are agreed upon by the borrowers and lenders, which are considered to be the parties in this type of transactions in the financial institution. Okay, and the second type is, we also mentioned that earlier, the derivative instruments. So here, the value as discussed in the classification of financial markets. So when we say derivative, their value are based on an underlying asset. So they can be based on bonds, stocks, interest rates, currency, or indices. Okay, so that is for derivatives. And they also are or can be in the form of equity option contract. For example, a derivative because it derives its value from the stock or shares. Uh, the option also gives the right but not the obligation to buy or sell. So by the way, in the derivatives, we have the option, which is the right but not an obligation to buy or sell the stock at a specified price and certain date. So the price of the stock rises and falls. So too does the value also of the option, although not necessarily by the same percentage. Because again, in this case, the derivative instrument also based its value on the underlying stock. So therefore, if there are any changes in its value, so it will follow, but not necessarily on the same percentage. Okay, so that are the two main types of financial instruments. Okay, so the next is the types of asset classes of financial instruments. So earlier we also mentioned this. An asset or cash instrument can be in the form of debt or equity-based financial instruments. So for the first classification, under the debt-based financial instruments, these are short-term debt-based financial instruments that last for 1 year or less. So securities of this kind includes, or the examples of this are your treasury bills and commercial paper. Cash of this kind can be deposits also and certificate of deposits. So this is under the debt-based financial instruments. Okay, for the second class, under the equity-based financial instruments, so the securities under this type of financial instrument are stocks. So exchange traded derivatives in this category include that is a derivative instrument, so stock options and equity futures or over-the-counter derivatives. Okay, so those are the two types of asset classifications of our financial instruments. So we will not deal with this thoroughly because I know that you are not a financial management major student. So uh, the purpose here is just to for you to understand the concept. Okay. So again, these are the two types of asset classes of financial instruments: the debt-based financial instrument and equity-based financial instrument. Okay, so we go now to the financial crisis. Okay, so what is a financial crisis? So when we say financial crisis, asset prices see a steep decline in value. Businesses and consumers are unable to pay their debts, and the financial institutions experience liquidity shortages. So, meaning to say, if a particular country or economy is facing a financial crisis, the prices of the asset are declining when it comes to its value. So, here, the businesses and even the individuals are not able to pay their debts anymore because the effect of the declining prices of the assets may have affected their level of liquidity, and therefore or they have already exhausted all their assets to pay for the liabilities, and still there are liabilities that are uh, not paid because the assets are not enough to cover for those liabilities. And financial institutions, those different financial institutions that we have mentioned, are experiencing liquidity shortages, meaning to say, the financial transactions are having problems, and uh, the the party, for example, the corporation who has the liability on their investors, are not able to pay for any uh, liabilities due to those creditors anymore. Okay, so these are the uh, cases or situation in which a particular country or economy is in a financial crisis. So, in addition, the financial crisis is also often associated with a panic or a bank run, during which investors sell off their assets or withdraw money from savings. because they fear that the value of those assets will continue to drop if they remain in the financial institution. So the money that they have invested before were now withdrawn. But the problem uh, is are those institutions which uh, accepted or has the liability for those investors are able to pay? So that is the question also. So meaning to say there is a trouble, okay, between the investors and the uh, corporations which has the liability. So other situations also that may be labeled a financial crisis include the bursting of a speculative financial bubble. Okay, so we will learn that later in the example of our financial crisis. A stock market crash, a sovereign default, or a currency crisis. So, a financial crisis may be limited to banks, or it can be spread throughout a single economy. It can also be the economy of a region or economies worldwide, depending on the type of crisis that happened. Okay, and the different stakeholders that has direct influence or connection with that of the institution that uh, fall. So here, the contributing factors to a financial crisis include system failures, unanticipated or uncontrollable human behavior, incentives to take too much risk, regulatory absence or failures, are contagions that amount to a virus like spread of problems from one institution or country to the next. So that's how great the impact is of a financial crisis. So depending on the case, so again, there are a lot of factors that can be considered to um, affect or cause this financial crisis, including human behavior as well. So, if this financial crisis is left unchecked, a crisis can cause the economy to go into a recession or depression. So, when we say uh, recession and depression, okay, so this is okay. So, when we say recession, this is a significant decline in economic activity. Okay, so that can be spread across the economy. It can last more than a few months. Normally, it can be seen or observed in real gross domestic product of the country, real income, employment, industrial production, and wholesale or retail sales. So a recession begins just after the economy reaches a peak of activity and ends as the economy reaches its throw. So you can or this discussion all actually is related to economics. So if you have already taken that subject, you have learned about the different stages of economy. Okay, so or economic activity. So recession means the downfall. Okay, because of the financial crisis that is being faced by the economy. So what about depression? So when we say depression, um, it is commonly defined as a more severe version of a recession. So here, meaning to say, this is actually where the downfall of the economy lasts for a longer period of time, and it's quite difficult for it to recover. Okay, so it would take a long period of time to recover. So even when measures are taken to avert a financial crisis, they can still happen, accelerate, or deepen. Okay, depending on the actions that can prevent or minimize the negative effects of this financial crisis. Okay, so in your module, we have there the different examples of financial crisis, but in this slide, I only selected three examples. So we have for the first example, Tulip Mania in 1637. So Tulip Mania was a period in the Dutch Golden Age. So during which the contract prices for some bulbs of the recently introduced and fashionable tulip reached extraordinary high levels and then dramatically collapsed in February 1637. So meaning to say they sold the tulips for excessive value, and then later its value significantly dropped. So this is an example of a speculative bubble or asset bubble in history. So meaning to say here, there are there, there there are some things that they have done in order for the people to actually believe that the tulip was that great in terms of its value. So they um, accepted that idea, and they were able to sell those tulips for actually more than what a person is receiving in terms of his salary. So just imagine how expensive tulips was on that days. However, it dramatically collapsed as well. Okay, in February 1637. So in many ways, the tulip mania was more of a hitherto unknown as socio-economic phenomenon than a significant economic crisis. So historically, it had no critical influence on the prosperity of the Dutch Republic. So the world's leading economic and financial power in the 19th century. So this tulip mania is now often used metaphorically to refer to any large economic bubble when asset prices deviate from its um, market values. Okay, so I just imagine just a selling of tulips. Okay, can is will I mean affect or does not necessarily affect the whole economy, but it has the capacity to uh, have some impact on its economy, because this crisis actually did not last for long. Okay, so in addition, so this tulip mania occurred in Holland during the early to middle 1600s. Okay, so again, they drove the value of tulip bulbs to extremes. So at the height of the market, the rarest tulip bulbs traded for as much as what I've mentioned earlier, six times the average of a person's annual salary. So today, the tulip mania serves as a parable for the pitfalls that excessive greed and speculation can lead to. So again, because of the greed of those people who are selling those tulips, later on it was found out that it was like a scam. Okay, so the next example is the credit crisis of 1772. So here it is also known as panic of 1772. So this is a peacetime financial crisis which originated in London and then spread over to other parts of Europe, such as Scotland and Dutch Republic. So here in 1770, the Great Bengal Famine of 1770, which was exasperated by the actions of the East India Company, led to massive shortfalls in expected land values for the company. So as this information became public, the 30 banks across Europe collapsed. Okay, they collapsed because of the effect of the massive shortfalls in the land values. Okay, so here they lost almost 300,000 uh, dollars. Okay, and on June 8, 1772, so the person behind this crisis or scam have fled to France to avoid debt repayment, and the resulting collapse of the firm stirred up panic in London. So here, economic growth at that period was highly dependent on the use of credit, which was largely based on uh, upon people's confidence in the banks. So because of what happened, they now doubted na entrusting banks because here because of what had happened, meaning to say there is a doubt, okay, when it comes to the uh, trustworthiness of those people in charge of the financial transactions. Okay, so another example is the stock crash of as 1929. So this is actually the Wall Street crash of 1929, also known as the Great Crash. So this is a major American stock market crash that occurred in the fall of 1929. So it started in September and ended late in October when the share prices on the New York Stock Exchange collapsed. So it was the most devastating stock market crash in the history of the United States when taking into consideration the full extent and duration of its after effects. So the crash which followed the London Stock Exchange crash of September signaled the beginning of the Great Depression. So again, I all know that the stock market is where uh, buyers and sellers of equity and debt instruments take place. So this is where the investors place their money and the corporations take those investment to be used as additional fund for their business. So when the stock market collapsed, meaning to say all the investors who invested their money can now, they cannot withdraw anything out of their investment. So that uh, crisis was or it has a negative effect, okay, on the other financial institutions as well, and of course the effect of this in the investors. Just imagine if you were one of those who invest in those times, so you did not get anything out of your investment, okay, and then there's nothing to invest, and the companies are now um, also having trouble paying for their investors. So just imagine how difficult that time was for the financial institution. Okay, so that's why it's considered to be the Great Crash. Okay, in the history of the market or the capital market or stock market in the United States. So those are the three examples of financial crisis. You can also have other examples if you would like to search it from the net or in your module. I have provided also some of the examples. So that's the end of our presentation for this module 2 entitled Financial Environment.